I'm John Hanna for CDTV.net in New York, and we have Dirk van Dijk, Chief Equity Strategist for Zacks.com, joining us from Dayton, Ohio. Hey, Dirk, how you doing?
Hey, John. No, not too bad.
Great. Now, getting ready for the Thanksgiving, huh?
Yeah, ready to, stuff myself after stuffing the bird.
Here you go. All right, so Dirk, the GDP came out this morning. What are your thoughts about it?
Actually, this was a really nice report and revision. Not only did GDP get revised up to 2.5% from 2.0%, which was better than the expectations, which were for like 2.3 or 2.4 percent going in. But the quality of the growth improved rather significantly. In that we got a actual smaller contribution from adding to inventories. So in the first look at the data, when we had 2.0% growth, 1.44 of those points, 144 of the 200 basis points, came from just simply stocking the shelves. Now we're up to 2.5% growth, with only 1.30 of those points coming from stocking of the shelves. And so that was actually a downward revision there in the low quality parts. But, personal consumption expenditures, the C in C plus I plus G plus X minus M, that increased to adding 1.97 growth points from 1.79. That's a nice upward bump. That's pretty high quality growth, although I do think that the U.S. economy relies too much on the consumer, and over time we would like to see that coming down, but that's a lot better than stuff that's just coming from inventories. Within where the consumer is spending, the contribution from goods increased to 81 basis points from 64. That's a nice little boost. And within that, durable goods increased to 0.53 points from 0.44, and non-durable goods increased to 0.28 from 0.20. So up on both fronts, more of it coming from durable goods, and durable goods are, only half the size of non-durable goods in terms of the overall economy, but tend to be much more volatile and much more important in determining whether the economy is doing well or doing poorly. The contribution from what people are spending on services was virtually unchanged at 1.16, up from 1.15. So, and services is by far the biggest. It's about, 2/3 of all overall consumer spending. And so it's not surprising that it's, bigger in absolute terms than either non-durable or durable goods. But it tends to be, fairly stable, especially compared to durable goods. On the investment front, you got to really break up investment a couple of ways. Overall investment actually declined a little bit in its contribution, going from 1.54 to 1.51, but that includes the inventory investment, right, which I already said declined. And then within investment, you also have to say, all right, there's fixed investment versus the inventory investment. That doubled from a real easy comparison to 20 basis points from 10 basis points. With you actually had non-residential investment increase to 0.96, and all of that increase came from investment in equipment and software, which contributed 111 basis points versus 80 basis points in the first cut. Now, that is really good news. That is the highest possible quality growth that we can have. That is businesses investing in for the future. That's the the engine that's going to drive future growth. So that was highly, highly encouraging. Investments in non-residential structures, putting up new office buildings, shopping malls, etc. That was actually revised to a 0.15 drag or 15 basis point drag on the economy from being up 10 basis points. Not a big factor really one way or the other, but combined, it's 25 basis points worth of effective drag. Frankly, when the original report came out, I was a little surprised to see the non-residential structures being a positive. This was more in line with my original expectations. Residential investment, home building was, again, a drag on the economy, but of 75 basis points rather than 80 basis points. So at the margin, a little bit less drag helps contribute to growth. Home building is still in the dumper. It doesn't look like it's going to get better anytime soon, although, we're so far down that it wouldn't take that much to actually see it start to contribute, because it's always relative to the prior quarter. So we actually might see a little bit of a positive in the fourth quarter, and certainly less of a drag from residential investments in the fourth quarter than we saw in the third quarter. That will be a big help to the economy, not having that sort of drag on the economy. And that doesn't require that home building has to go back into a boom. That's just stopping getting worse. Now, we'll get a much better read on that as of tomorrow when we get the new home sales coming out. The other major area of improvement is we had less of a drag from the trade deficits, or net exports. And instead of subtracting 2.01 points from growth as the data on the original read, they only subtracted 1.76 points. And net exports, the trade deficit really is a much, much bigger problem, particularly in the short term, than the budget deficit is. So, that was sort of good news, and it sort of came on both fronts. Exports added 77 basis points instead of 61, and imports subtracted 2.52 and 252 basis points rather than 261. So a little bit of improvement on both imports and exports, i.e. more exports, less imports, and that helped fuel the upward revision. Overall, government actually was a more positive contributor to economic growth than we had in the original reading, coming in at 81 basis points rather than 61 basis points. And all of that change came from less of a drag from the state and local governments. The federal government's contribution stayed unchanged at 71 basis points, but state and local governments, instead of being a drag of 3 basis points, effectively unchanged, actually added 10 basis points. Again, not a lot of boost from state and local governments, but that was a bit of a surprise. I mean, state and local governments have been under a lot of pressure to be cutting spending and stuff like that, especially now with the stimulus money drying up. So looking forward, I would expect state and local governments to be much more of a drag as we look into the fourth quarter and into 2011. But overall, I was very pleased with this report, not just in the higher than expected headline growth and the fact that it was an upward revision, but from a major improvement in the quality of the growth. So, I think the market should have liked this report a lot, but it's kind of being swamped by the news from Korea, and which is pretty ugly. It's sort of hard to compete with an actual shooting war involving a nuclear power. So I think that's really the reason why the market is down today, not the GDP report, which was actually quite encouraging. Yeah, I mean, 2.5% growth is not great. It's not a boom, and it's really, we need to get it up over, say, 3% to really start making a dent in unemployment. But, you know, it is actually better than the average growth rate for under the Bush administration, even if you exclude the Great Depression. If you go from the first quarter of 2001 through the fourth quarter of 2007, i.e., leave out the Great Recession, right? Growth only averaged 2.5%. So we're actually above that growth rate. And if you include the Great Recession, particularly the first quarter of 2009, before the stimulus package had been even approved, sort of attribute that to Bush's economic performance. You know, his average growth rate during those 8 years, again, also sort of to be fair, removing the first quarter of 2001 and attributing that to Clinton, his average growth rate was only 1.3%. So we're running almost double what we did during the Bush years in the third quarter. Now that's not high enough, but hey, it's compared to what? And so I was encouraged by this report, and especially it coming from what I would consider quality sources, and especially the very high quality source of business investment in equipment and software. So by and large, a good report.
And Dirk, you have a nice Thanksgiving holiday with you and your family. And
okay, yeah, I hope everybody has a tasty turkey.
Thank you, sir. And that's Dirk van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. And I'm John Hanna for CDTV.net in New York.